Good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, July the 30th, 2025, recording this in the morning, just after 7. We've got a very busy day today. There's central banks, there's data, there's earnings. Let's have a quick look at the earnings just before we get onto other stuff. So obviously we've got some very big ones. We have Altria for the cigarettes, Kraft Heinz. That's going to be interesting because the idea is that Americans are sort of eating less junk food, apparently. So, some of those sort of very popular brands from Kraft Heinz under a little bit of pressure. So it's going to be interesting just to see about forward guidance there. Ford's also interesting one to see just what their sort of views are in terms of the sort of the tariff effect, the extra cost of sort of parts coming in with the tariffs, but also maybe less competition. So it's going to be interesting to see what Ford has to say. Then, of course, we've got sort of Robin Hood, which is, just in terms of retail sort of trading and whatnot. And of course, the two big guys, we've got Meta and Microsoft. Going to be interesting to see in terms of capital expenditure for Microsoft. Same thing as Meta. Is Zuckerberg going to go sort of all in on capital expenditure? So that's happening at 4 p.m. or after the bell anyway. So a lot happening. Then, of course, tomorrow we've got Amazon and Apple. So a lot happening there. But apart from that, we also have some data. So let's just start off and have a look at the data which we're getting this morning from the US. And there's quite a lot of data coming in. So first of all, we have the ADP employment change, which is sort of forecast to come in at 76,000. Last time it actually came in at minus 33,000, which was a bit of a shock to the market. Now, of course, we know the correlations with the final NFP number, which we're getting this Friday, are relatively low. But I had a bit of a deep dive onto this, and essentially ADP, it just has a slightly different methodology, and it's not that it's wrong or stupid. And in fact, without going too much into the details, some of the research I've done, it's actually, it does have quite a good grip on real data from real businesses in the private sector. So I think it's interesting to keep an eye on that. As I say, expected to come in, a little on the weak side, 76. But again, we'll see if the market wants to react to that because at 8:30, we have a bunch of other data. So we have the first read, the advanced reading on the second quarter of GDP, which of course, it's a little bit, it's not exactly up to date, but it is going to start to give us a sense of whether there's been a slowdown because of, the uncertainty about tariffs, or whether there hasn't been a slowdown and maybe the economy is just chugging along quite well. So let's just see what's expected. You see last time 0.5 came in last time. This time expected to be 2.6. Some of the research I've been reading the last 24 hours, quite a few economists are actually, talking about maybe 2.93, 3.1. So let's keep an eye on that. Personal consumption, is the US consumer still, consuming, basically spending, or are they starting to cut back because of maybe, sort of too much sort of interest rate problems, mortgages are still at high levels. Then, of course, we get some other information here with the price index, but I think probably we have the monthly PCE tomorrow, which might be a little bit more important. Okay, let me just grab some tea this warm morning. All right, the other thing we get at 8:30, which is going to be very, very important, is the quarterly refunding announcement. I had a bit of a chat about it with you guys on the video, I think on Monday morning, but let's just look at a few scenarios. We got the first bit of information on Monday afternoon at 3 p.m. That didn't seem to say too much in terms of any radical changes. We know that the government or the Treasury is looking to refund with just over about $1 trillion, excuse me, $1 trillion, $1 trillion of debt, which was nothing sort of odd or too sort of strange. So the chances are that there aren't going to be too many radical differences. But as I said, let's just do a quick recap of, let's say, about 4 different scenarios, just in case something does happen this morning at 8:30. So, probably sort of no change, that, maybe not too much of a change with the coupons. Remember, the coupons more sensitive 10 and 30-year sort of issuance. So let's see what happens with those. Let's see if there's any guidance about 2025. 2026. That's something to be looking out for. Of course, any guidance about increasing in 2026 would be pretty negative. That would be quite bearish. So it would get sort of a bear steepener there, would get the long end bonds sort of coming up and the yields on the long end are ripping higher. That would be positive for the dollar, negative probably for equities, and negative for gold, and negative for the euro. But that's probably not a sort of a high probability event. The other thing which is going to be really the focus of the market's attention will be if on the long end of the bonds, as I say, the so-called coupons, the 10 and the 30 year, if there is some kind of reduction, even like a small reduction to the number of coupons which are being planned to be auctioned. And the other issue here is whether they, let's say, for example, the US Treasury decides to reduce the number of coupons, do they sort of compensate or fund that by increasing the issuance in the 2 to 5 year range? So basically less 10s and 30s, more 2s and 5s. That would be relatively sort of bullish, and that would uh, that would be relatively bullish, but not the most sort of bullish amount. So if they sort of just sort of swap that from the 10s and 30s into the 2s and 5s, that and leave the overall number of issuance unchanged, that would be supportive. So you maybe want to be long stocks into that. A soft kind of short in the DX would probably have a little bit of weakness, and there could even be a bit of a flattener here as the long end yields came down a little bit. But the most bullish one, which is probably relatively low probability, would be, let's say, if they reduce the coupons, so they reduce the long end of the bonds, the 10s and the 30s, and there was no additional issuance on the 2s to 5s. Okay. And that would imply that there's going to be a lot more issuance at the front end of the curve on the bills. And that would be the most bullish. That would be very, very bullish, especially if they reduce the coupons by, let's say, more than 75 or 100 billion of dollars. That would sort of indicate, as I was saying on Monday, that the US government, they want to run the economy hot, and maybe even don't mind a little bit of inflation. But the problem there is that that's almost like a sense of a debasement for the US dollar, because it's essentially losing sort of fiscal discipline. And if that were to happen, you'd probably want to be long gold, probably long the euro, long the longer term bonds, at least in the short term, long the equities, and probably the US dollar on that one would sort of sell off. The other thing just to keep in mind, which is maybe another sort of, let's call it fourth possibility, is that they don't really change the issuance number or the number of coupons, but they sort of institute sort of a buyback program whereby they're buying back off the run coupons from the market. And then the question would be, would they sort of fund those with on the run similar duration, with the same sort of quantity of similar duration, or would they actually fund those buybacks with bills? And that would be a little bit more bullish. So overall, that would be like a little bit like a stealth QE, and that would sort of be positive for risk assets. So let's look at that. It's a little bit complicated, but let's look at that at 8:30 this morning. And as I say, the main thing we're looking out for is if the number of coupon issuance, so the 10s and the 30s, is that reduced? That's the key thing. Has that been reduced by how much? B, is there any sense that they're going to then increase in 2026? Would actually be hawkish, but let's assume they don't do that. And then the whole question is how do they sort of fund or compensate for any potential reduction in the number of coupons which are being issued? Is that going to be through bills? Is it going to be for the 2s or the 5s? And the more it's at the front of the curve in terms of the very front of the curve in terms of bills, the more bullish that will be for assets. So that's that. Okay. Now, so we have the data, we have the QA, we have and of course we have the Fed. Well, actually, we also have Canada. Let's have a quick look. We have the Bank of Canada this morning at, I think, 9:45. So if we actually just look here, let's have a look and just see what's, this is for Canada. So you can see for today's meeting, basically nothing is priced in. So the market is expecting absolutely nothing from the Bank of Canada. You can see here only a 5% chance of a cut. Keep in mind that the Bank of Canada over the last, sort of whatever, 6 months or so, they've cut about 200 200 basis points. So they've already cut substantially. And as you can see here, very different from the Fed. The effective rate here is down at 2.75%. Keep in mind the Fed effective Fed funds rate today is at 4.33. So 4.33 versus Canada at 2.75. The Canadian economy, it had a bit of a bump with employment at the last employment numbers, but overall the trend is for some weakening in the economy. If you look at sort of productivity and investment, capex, all this kind of stuff, and of course we have the tariff uncertainty and the latest news coming out of the trade negotiators. I was reading some stuff yesterday between the US and Canada, is that it's not looking optimistic. It's not looking like a sort of a Japan or European style pseudo deal. It looks as though the Canadians are negotiating, fairly toughly. The Americans are not really budging too much, and that there's no imminent possibility of a quick, sort of deal. So the point is that there is still a lot of uncertainty up in Canada, and I would imagine that the BOC today would not necessarily want to do anything too dramatic, and it's probably just waiting a little bit to see how the tariff negotiations go, how the real economy goes, and also what does the Fed do. And as I say, they already have cut 200 basis points over the last few months, and so maybe they're going to be relatively comfortable. Again, though, they are expected to cut a little bit more by the end of the year. I mean, at least like there's a 2/3 possibility of one more cut by the end of the year. But as I say, that's going to be dependent on economic data, the tariffs, and of course on the Fed. Okay, so that then leads us to the Federal Reserve. Excuse me. And I think we all know what's been happening with Trump and Powell and the political angle. We saw that debacle at the Federal Reserve building with the hard hats, etc. So let's forget at the moment. I will say, though, that I imagine that Powell today at the press conference will be asked some political questions. I expect him to bat those away, to maybe talk about the building and say that the cost runs are reasonable, the cost expenditures are reasonable, and to reiterate the fact that the Fed must maintain its political independence or its independence from the politicians. I don't expect Powell to particularly be critical of Trump or to say anything controversial. So what is he will say? What I think we should have a look at as well is that just in terms of the last summary of economic projections, which we don't actually get an update until the next meeting. But if we go back until the previous meeting, we saw that by the end of 2025, which we're rapidly getting towards there, the Fed funds was projected by the Fed itself to be at 3.9%. This is a rounded number, and that equates to 2 cuts. So the Fed themselves, a couple of meetings ago at the latest projections, SEP, the summary of economic projections here, were basically saying that they would cut twice. Now, of course, they don't need to follow this, but the market is still believing that. And just in terms of what could happen today, will Powell push back? First of all, will they cut? I don't think so. Will Powell say that September is live, October is live, December is live? It's possible. But just before we look at all that, keep in mind that in terms of the dot plot, yes, they did say they're going to cut twice, and Trump, is calling for Powell to be fired. But let's keep in mind that at the last summary of economic projections, we actually had 7 people, 1, 2, 3, 4, 5, 6, 7 committee members voting by the end of the year for no cuts. So this is the expected Fed funds rate at the end of the year. And keep in mind, it's 4.33 at the moment. So we're about here. And look at that. So we actually had, 7 committee members who were quite hawkish. So if Trump talks about firing Powell, he probably needs to fire another 7 or 6 people as well, because it's not only Powell who is reticent about cutting rates. Now, what we do have is potential for a dissension or two today. We know that Waller, in his speech, about 2 weeks ago, essentially laid out a pretty coherent plan for cutting at this meeting. So not even in October or September or December, but at this meeting. So we can assume that Waller will vote for a cut and will dissent, and that's basically advertising for a job as the next Fed chair. But also possibly Michelle Bowman, who is less dovish than Waller, but sort of open to the possibility of cutting. So we could have 2 dissensions today. Now, if we have more than 2 dissensions, let's say 3, maybe someone else says that they wanted to cut today, that would start to indicate that Powell maybe is facing quite a lot of internal dissension, and debate, and that is not great for the stability of the Fed. Although having said that, historically the Fed, has had maybe not so much in the last 10 or 15 years, but if you go back, 20 or 30 years, there has definitely been the occasional dissenter. So that's going to be something interesting to look at, and the market will be looking at that because obviously the more dissenters, that's the more dovish it is. Or if there's no dissenters, let's say, for example, Waller today does not dissent. I'd find that quite, I don't want to say shocking, but interesting that he felt the need to backtrack, and that would be quite hawkish. So as I say, technically the Fed themselves saying that they're still on track to cut twice. Now let's see what the market's saying about that. The market still essentially doesn't exactly agree. We can see here that what's priced for today is obviously nothing at all. But then when we start going out to September, we get a 2/3 possibility chance of a cut. So 16 basis points out of 25. And the market prices in the first cut, 1.1 cuts by the end of October. So remember, there's also an October meeting. So we have September, October, and December. So there's still 3 more meetings after this one. And then, of course, by December, we have 1.8 cuts. So not exactly 2. It's been going up towards 2, then depending on data, going down a little bit up and down. So, I've been showing this a little bit over the last month or so. It's been sometimes a bit more than 2 cuts, a little less than 2 cuts. But essentially, the market is broadly in agreement with the summary of economic projections that the Fed will cut at least once and quite possibly twice by the end of the year. So let's see what Powell has to say today. As I say, I expect, it's going to be tricky because if we look at something like the core PCE, which I just pulled up here, this is the Fed's, as we all know, preferred gauge of inflation. This is the year-over-year core number. So not month over month, the year-over-year core number. And technically, this is what the Fed is looking at. Or they're looking at everything, but this is their target. You can see that it's obviously it's come down a lot since the bad old days of 2022 when it was up almost at 6%. But the point is, it's flatlined essentially since, basically in 2022. So it was coming down quite a lot in 23, 24. But basically, once we get to, I don't know, sort of the middle of 24, you could see here, what's this, June 24, that essentially it's flatlined. It's gone up a little bit, down a little bit. And currently, as we speak, it's at 2.67. Now, that's above the Fed's target of 2. Now, you could argue, which is what the Trump administration is, that, it's just a little bit above 2. Relax, it's going to come down. But if it's at 2.67, plus we have the possibility, according to members of the FOMC, that the tariffs will ultimately cause a little bit of inflation. I think the Fed, and specifically Powell, who got inflation wrong back here in 2021 and 2022, I think he's very concerned that that's going to push up to the 3% chance. So, we also have an unemployment rate, which is only about 4% or so, which is, I think, 4.1, which is very low historically. So Powell, I think, quite cogently can argue and say, hey, inflation is not defeated. We possibly have some inflation coming later in the year from inflation, from the tariffs rather, and the employment situation is strong, so there's no need to cut. Of course, there is enormous political pressure on him. So I think today he's probably going to say that he's going to say that he's data dependent, waiting to see what happens. And, Trump no doubt will start tweeting and calling him an imbecile and whatnot. But that's it. So let's just have a look here at inflation swaps as well. Just want to have a look at the inflation swaps here. And you can see here, so this is all the different tenors. So this is the 1 year. And again, this is on a daily chart. And you can see here that over the 1 year, basically, going back, we can go back, let's have a look, where are we going back to, let's say, the beginning of the year. You can see that for the 1 year, which is the white one, which I'll highlight here, it's over 3.4% for the 1 year. So the point is that this is the market-based measure of inflation. The market is still quite worried. And even if you go out to the 2 years, it's not as high. It's over 3%. Go out to 3 years, 2.8. Even if you go all the way out to, let's say, 10 years, or actually go the 5 year, it's still at 2.67. So the point is that even going out, 2, 3, 4, 5, 6 years, and we go all the way out to 30, it's still at 2.47. So the market is saying that inflation is not defeated, even if it's not crazy and out of control. And so I think if the Fed were to be dovish today, that could cause the front end yields to go down. But I think actually would cause the long end yields to go up because the market would be worried that the Fed is becoming less tough on fighting inflation. And we could get sort of a pretty nasty sort of steepener, a bull steepener happening there. On the other hand, what the market wants to see from the Fed is a Fed which is politically independent and also is still fighting inflation, in which case that will maintain a bit of sort of discipline on the long end yields. Okay, so that's about it for today. I'm going to wrap up. So as I say, I was kicking off with ADP at 8:15 in about 45 minutes or so, and then we have all the data dump at 8:30. We have the QRA. As I say, keep focused on what they do with the coupon issuance and then how they redistribute and refinance that. And then, of course, we have the BOC, and then we have the Fed and earnings coming in this afternoon. So a full day with plenty of stuff. And I think, by the time we get through to the end of this week, we'll certainly have a sense of whether the equities can maintain those lofty levels or they are actually overbought. And let's see if the US dollar rally, which we've had, is only a short squeeze. Or whether that has legs to run. We shall see. Okay, guys, I'm going to leave it there and we'll keep this conversation going tomorrow and see how it all pans out. Thank you very much. Have a great day.